Hello. In this presentation, I'm going to look at sources of finance, i.e. how and from where organisations will raise the finance they need in order to operate. This analysis and discussion makes up the financing decision referred to in the Objectives of Financial Management presentation. Specifically, this presentation will cover the general concepts underlying the decision, short-term sources of finance, long-term sources of finance, implications of the decision made, raising equity, rights issues, and Islamic finance. Let's look at each of these in turn. General concepts underlying the financing decision. There are two basic guidelines to bear in mind as you consider and compare the various sources of finance that are potentially available. 1. The link between risk and return. This is discussed further below. And 2. There are two parties involved in a financing transaction, namely the lender and the borrower, and there must be benefits to both if the transaction is to go ahead. Imagine a scenario where you have £1,000 to invest. You could put your money into a bank or building society account. However, whilst your money would be safe, you are extremely unlikely to lose the money, you will not generate a particularly attractive return. Alternatively, you could consider putting your money into a company, i.e. buy shares. Unlike the previous option, your money is certainly not safe. Indeed, there is a very real possibility that you could lose your £1,000. This begs the question as to why you would take the risk. The simple answer is the potential to make a much higher return. In other words, you would only take the risk if there is the potential to get a higher return, and the higher the risk is perceived to be, the higher the potential return required. Ultimately, a risk may be seen as so high that you cannot foresee the necessary return and so will not be prepared to invest. Short-term sources of finance. There are a number of ways that a company can raise money where the need is short-term, i.e. up to around 12 months, and it is important to consider the pros and cons of each. Some of these sources are considered below. An overdraft is a facility whereby an organisation can spend more money than it has in its account. Effectively, it is spending the bank's money rather than its own and will be charged interest for the privilege. There is also likely to be a penalty fee imposed where the facility is not agreed with the bank in advance or where agreed limits are exceeded. An overdraft is quick and easy to arrange and is very flexible in that you only use what you need to at any point in time. The interest rate incurred is likely to be higher than that on a loan. However, it can still work out cheaper as interest will only be applied to the amount used rather than the whole amount agreed as with a loan. The major drawback of an overdraft is that it can be recalled by the bank at any time. A short-term loan is an advance of money by a bank or similar institution to a company for an agreed period of time, and, like the overdraft, is relatively quick and easy to arrange. Interest will be applied to the outstanding loan balance periodically. To some extent, the pros and cons are the opposite of those explained above in relation to the overdraft, i.e. it cannot be recalled, unless any pre-agreed terms and conditions are breached, and it is a lower rate of interest. Conversely, it is less flexible and interest will be applied to the whole balance even if the company does not require it all at a particular time. Commercial papers are issued by companies and are effectively a formal IOU agreement. They enable organisations to raise relatively large amounts very quickly and are extremely flexible in that the terms can be whatever the company and the investor agree. A slight drawback is that they can only be issued by very large companies with excellent credit ratings. Trade payables, whilst not normally thought of as a source of finance, is effectively borrowing from your suppliers. It is a readily available, free source of finance. However, companies should guard against damaging the goodwill with a supplier. Payables are discussed in more detail in the Management of Receivables and Payables presentation. Long-term sources of finance. Where the financing need is longer than 12 months, the sources can be categorized between debt and equity. Strictly speaking, equity refers to raising money by issuing ordinary shares. However, preference shares are sometimes considered under this heading. Investors acquiring shares are referred to as shareholders, and in the case of ordinary shareholders, they are the owners of the company and will be entitled to vote on matters raised in open meetings. In return, they may receive a dividend if the directors deem sufficient funds are available. The attraction to the company is the flexibility to only pay what they can afford, whilst the attraction to the shareholder is the potential to make a limitless return. Preference shareholders do not usually get a vote, and dividends that are paid, like the ordinary dividend, is at the discretion of the directors, are a fixed percentage of the nominal value. For example, 6% £1 preference shares will pay a dividend of 6 pence, 6% of £1, assuming one is paid at all. Preference dividends have to be paid before ordinary dividends, and in the case of cumulative preference shares, dividends not paid in 1 year are carried forward to the next. Accordingly, in the above example, if the 6 pence is not paid 1 year, 12 pence can be paid in the second year, 18 pence in the third, etc. A company must be fully up to date with preference dividends before it can consider paying anything to ordinary shareholders. Debt can be raised either in the form of a loan, the considerations discussed above will still apply, or via what might be termed tradable debt, i.e. debt that can be sold on from one investor to another in much the same way that shares are traded. The company will issue a debenture certificate, similar to a share certificate, as proof of monies invested, and the funding may be referred to as debentures, bonds, loan stock, debenture loan stock, etc. More detail on debentures can be found in the cost of debt presentation. Another source of debt finance is the use of leases, and these again will be the subject of a separate presentation. Implications of the decisions made. A company will need to consider the pros and cons of particular sources within the context of their individual circumstances. However, a major consideration will be the implications of using debt as opposed to equity. There are advantages to using debt, not least of which is that it is usually cheaper than equity due to the lower risks faced by the investor. The costs of debt and equity will be covered in separate presentations. Other advantages will include interest will usually attract tax relief, making it even cheaper still. The fact that interest must be paid makes cash flow forecasting easier and can act as a discipline on management that they understand and plan their cash resources. Taking on debt can send a signal to the markets that management have confidence in their cash flows, as otherwise they would presumably not wish to burden themselves with debt obligations. Conversely, as referred to above, debt brings with it a financial obligation in that interest and potentially the redemption of the loan have to be met. Failure to do so may result in the company being forced into liquidation. Consequently, a company that cannot meet its interest obligations, or even is perceived to be unlikely to meet them, is seen as a high risk. This higher risk level may increase the cost of debt or potentially make debt sources unavailable. Summarizing, whilst there are benefits to using debt, the company must guard against taking on financial obligations that it cannot meet. The debt level can be assessed and compared to industry norms by calculating the gearing level, debt as a percentage of equity, and interest cover, PBIT divided by interest, which assesses the ability of the company to pay its interest. Raising equity. Where a company already has shares in issues, any new shares must, in the first instance, be offered to existing shareholders. This is called a rights issue and is discussed in more detail below. Where a company is looking to issue shares for the first time, or where they have existing shareholder permission to do so, a company can issue shares externally, i.e. to new investors. In so doing, they will want to do so as quickly and cheaply as possible. Accordingly, their first choice is likely to be a placing, i.e. they place the shares to be issued with an institutional investor. Merchant banks will assist in identifying potential investors. However, there will be a limit as to how much can be raised via this method. For large share issues, a public offer is likely to be used. Now, shares can be obtained by anybody. However, it will be expensive, as the issue will need to be advertised, administered, and underwritten. Underwriting refers to an institution agreeing to buy up any shares not subscribed for by the public. Any shares bought up in this way will usually be acquired at a discount to the issue price, and there will be a fee paid to the underwriter even if their services are not ultimately required. Rights issues. When a company wants to raise capital by issuing new shares, in the first instance these shares have to be offered to existing shareholders. In other words, existing shareholders have the right, known as preemptive rights, to first refusal on new shares. Usually these shares are offered at a discount to the current share price. 18 to 20% is typical, and this will cause a dilution of the share price. The price at which the shares will trade after the issue is referred to as the theoretical ex-rights price, or TERP, and can be calculated as follows. Imagine that a company offers a 1-for-4 rights issue at a 20% discount to the current share price, the cum rights price, of £2. This means that an existing shareholder has the right, though not the obligation, to buy one new share at the rights price of £1.60, £2 less a 20% discount, for every 4 shares currently held. To calculate the TERP, consider a shareholder who holds 4 shares worth £8, 4 times £2. If they exercise their rights to buy the new share at £1.60, they will then own 5 shares worth £9.60, £8 plus £1.60, which produces a share price of £1.92, £9.60 divided by 5 shares. As referred to above, shareholders are not obliged to take up the rights offered and are also entitled to sell them to other investors who are interested in buying shares in the company. In theory, the rights will be sold for the difference between the TERP and the issue price. So £1.92 minus £1.60 equals 32 pence in the above example. In practice, the rights value will be influenced by the desirability of the share purchase. Based on theoretical values explained above, the wealth of an investor will remain the same as long as they do something, i.e., either exercise or sell the rights. It should also be noted, however, that a shareholder who sells their rights will relinquish some of their control. Islamic finance. Islamic finance is a rapidly growing area in finance and is not just restricted to Islamic banks. Islamic finance products are products that are Sharia compliant, i.e. acceptable under Islamic law. This is an extremely complex area, and this presentation is not intended to give more than an overview. However, there are 2 basic principles. 1. The earning of money from money, i.e. interest or riba, is immoral. Instead, money should be earned from business endeavour. And 2. Traditional debt approaches are unfair in that the lender receives a guaranteed return irrespective of the borrower's outcome. For example, the lender receives the agreed rate of interest, let's say 5%, whether the funded business makes 0% or 20%. Accordingly, Islamic finance products are all concerned with sharing the risks and rewards in some way, and examples of products include the mudaraba is a form of partnership whereby one partner provides capital and one provides expertise. Profits are shared according to a predetermined agreement, however, all losses are borne by the lender. The musharaka, similar to the mudaraba, however, all parties input capital and all parties can be involved in the management of the business. Profits are shared according to a predetermined ratio, while losses are shared according to capital amounts input. The muaraha. A bank acquires assets at the request of a client and sells them to the client at a markup, often for a deferred payment. The markup reflects the services provided by the bank and the risk carried by the bank that the client may not complete the purchase. Ijara is similar to a traditional lease, and a bank will purchase an asset and rent it to the company for a predetermined period. At the end of that period, a new current rate can be agreed for a subsequent period of use. Thank you.